In the last 48 hours, silver did something it wasn't allowed to do. It didn't just dip, it failed hard, right at the level where every breakout trader expected the next leg higher to begin. 50, and it did it with a 14% one-day jump, the biggest single-session gain in decades. The message looked clear. Momentum had taken control. Then the market answered with something else entirely. 63. Not months, not weeks, in days. 01, as if the market was refusing to pretend the damage was temporary. They said a move like that could never happen in a modern, liquid precious metals market. Not with all the hedgers, not with all the algos, not with all the supposed depth. Yet it happened anyway, and it happened fast. The reason this matters isn't the drama of a chart. It's what the sequence reveals about who had the real information, who controlled the leverage, and where the pressure points actually are when silver tries to run. Because while the headline is silver crashed, the story underneath is far more precise. This was a stress test. A breakout attempt met a rule set, and the rule set won. If you only watched price, it looked like chaos. If you watched the plumbing, it looked like a tightening of the system at the exact moment enthusiasm peaked. The difference between those two views is the difference between confusion and clarity. Welcome to Signal and Structure. Here we decode margins, flows, inventories, and positioning before they become headlines. If that kind of calm, data-first breakdown helps, consider subscribing. And comment where you're watching from, because silver never looks the same from New York, London, Mumbai, or Shanghai. No hype, just the signals that actually move markets. Now let's reconstruct what happened, step by step, without the noise. Start with the move that set the stage. Into late January, silver was behaving less like a sleepy industrial metal and more like a crowded trade. Or, that day wasn't just a price event, it was a positioning event. 6 million call options, changing hands, a level of call activity that screams one thing. People were chasing upside with conviction and leverage. In a normal market, that kind of enthusiasm would be followed by consolidation, maybe a pullback, then another attempt. But silver is not a normal market when leverage stacks on top of a thin physical base. Silver is a market where paper claims can multiply far faster than bars can move. And when that multiplication gets too aggressive, the system has a set of knobs it can turn. The first knob is margin. Margin is not a headline most people track, and that's exactly why it's powerful. A margin hike doesn't need to predict direction. It only needs to change the cost of staying in the trade. When the cost rises suddenly, the weakest hands don't get to argue. On January 31st, the CME raised margin requirements for gold and silver. Around the same time, Shanghai venues lifted silver-related margin and limits, with changes taking effect on January 30th. The timing matters. Itself at the new collateral level, and that's what happened. It fell into a vacuum. That's a breakdown of more than a third in days. It's the kind of reversal that doesn't just punish optimism, it rewrites the narrative. Here's where it gets interesting. As the paper price collapsed, January still delivered roughly $1 billion into silver ETFs. That's the contradiction. Capital was still choosing silver exposure even as leveraged paper was being forced out. 01, confirming this wasn't a quick shakeout, but a sustained repricing. After a drop like that, many treat the market as a new regime, and in silver that usually means leverage is being purged and the next move will be decided by whoever can hold without it. Notice how quickly the mood flips in those moments. On the way up, every pullback looks like a buying opportunity. On the way down, every bounce looks like a trap. The data doesn't care about the mood, but the mood determines how liquidity behaves. Bids get cautious, spreads widen, and the market starts moving in jumps instead of steps. That's why late January didn't feel like a normal decline. It felt like air being pulled out of the room. And there's another detail that gets lost. The move wasn't isolated to one venue. Futures, options, ETFs, and leveraged exposure products were all responding to the same stress, but in different ways. Futures were the front line because they are the most levered exposure for many participants. Options were the accelerant because call buying can create dealer hedging that pushes price up and then reverses when the flow turns. ETFs were the slow-moving bridge because they reflect broader capital allocation rather than intraday leverage. When all three are active at once, silver can look calm one week and unrecognizable the next. So when you hear the phrase silver crashed, translate it into mechanics. Leverage was flushed, hedges were recalibrated, and liquidity demanded a higher price for risk. Now add another layer. Inventories. The London Vault System reported 27,818 tons of silver at the end of December 2025. That's a huge number, and it sounds like abundance. But inventory numbers in bullion markets are rarely as straightforward as they appear. Some metal is earmarked, some is pledged, some is not available at a price, and some is effectively spoken for by industrial flows. 36 tons as of January 30th, 2026. Again, big. Again, not the same thing as free supply. So we have price collapsing, ETF money flowing in, and vault totals that look stable. That's the dislocation. Paper price behavior is signaling panic, while the broader ecosystem of ownership is signaling continued interest. Why does that gap matter? Because gaps like this don't persist forever. They resolve. Either physical demand gives up and stops absorbing metal, validating the price drop, or the paper market overshoots and has to reprice when physical tightness asserts itself. The point isn't to declare which outcome is guaranteed. The point is to understand that the market is split, and splits create volatility. To see this pattern, you have to look backward. Silver has a habit. It rises in a way that feels overdue, then it gets smothered by mechanics, and the smothering looks like betrayal to anyone who believed the story more than the structure. In 1980, silver became the symbol of inflation fear and speculative fervor. The price went vertical, and then the rules changed. Margin requirements rose, liquidity dried up, and the unwind was brutal. The market didn't negotiate with late optimism. It crushed it. In 2011, silver ran again, fueled by post-crisis monetary anxiety and a narrative of currency debasement. The price surged, and then margin hikes arrived like a hammer. The trade was crowded, leverage was high, and the air pocket below price was deeper than most realized. Silver dropped hard, fast, and left a scar on an entire generation of precious metals traders. Now, in 2026, you see echoes of that playbook. A fast upside move, a surge in speculative call buying, then margin adjustments, then a violent repricing. Different decade, same mechanism. This is not opinion. This is pattern. The market is telling you that when silver tries to break out, it collides with a system designed to contain leverage before it spills into disorder. Silver is unique because it sits at the intersection of investment desire and industrial necessity. That means it attracts narratives from both sides. But it is priced in a way that is still heavily influenced by derivatives, where a large amount of exposure can be created with relatively small amounts of capital until margin rules change. So who are the players that matter here? First, the exchanges. The CME is not a villain. It is a risk manager. Its primary job is to keep the clearing system intact. When volatility spikes, its mandate is to ensure counterparties can meet obligations. Raising margin is a tool to protect the clearinghouse. But the side effect is that it forces participants to reduce positions if they cannot post additional collateral. That is why margin is a lever over price. Second, the large banks and market makers. They provide liquidity, they hedge, they warehouse risk, and they profit from the spread between chaos and order. When volatility rises, they widen spreads. When margin rises, they adjust risk. They are not sentimental about narratives. Third, the funds. Some are long volatility, some are short volatility, some are trend followers, some are carry traders. When a market is moving up, trend funds add. When the market breaks, they flip, and their flipping is mechanical. The moment key levels fail, the models don't ask why, they execute. Fourth, the ETF ecosystem. ETFs are a bridge between the public and the bullion system. Inflows signal demand for exposure, but the way that demand translates into physical movement depends on creation and redemption mechanisms, authorized participants, and the willingness of the supply chain to deliver metal at a given spread. ETF inflows can coexist with futures declines, especially when futures are the primary pressure valve for leveraged liquidation. Finally, the industrial side. Silver is used in electronics, solar, medical applications, and a long list of processes where it is not a trophy asset, but an input. Industrial demand does not chase price the way speculators do, but it does respond to disruptions. When price collapses, some buyers step in. When supply chains tighten, they scramble. That behavior creates a different rhythm than the futures market, and those rhythms can diverge sharply during stress. Now, connect the dots with timing. You saw a parabolic move in January 26. You saw extraordinary call volume. You then saw margin measures tighten by January 30 in Shanghai and by January 31 at the CME. Then you saw the price unwind accelerate. That sequence is a signature. It suggests the system responded to volatility by raising the cost of leverage, which then forced liquidation, which then fed volatility, which then justified the tightening. It's a feedback loop. Here's where most people miss the point. They think the cause was a narrative shift, a rumor, a headline, or sudden change in fundamentals. But markets often break because the cost of holding the position changes, not because the story changes. The story is what people tell afterward. The mechanism is what matters. Let me make margin concrete. A futures contract is not a share of stock. It is a leveraged agreement with daily settlement. When the exchange raises initial margin, it is saying, to hold the same exposure, you must post more cash. If a trader is long and the market drops while margin rises, they get hit twice. The position loses value and the collateral requirement increases. That combination creates forced selling even in people who still believe in the thesis, because belief does not meet a margin call. Cash does. This is why margin changes are so disruptive in parabolic markets. In a calm environment, raising margin is an inconvenience. In a leveraged blow-off, raising margin is a detonator. It turns voluntary risk into mandatory liquidation. And mandatory liquidation does not look for fair value. It looks for survival. Now add dealers. 6 million calls that changed hands around the peak. Dealers who sold those calls often hedge by buying futures as price rises. That hedging can feed the move higher. But when price breaks, the hedge needs change. Dealers can end up selling futures as the market falls to stay neutral. That flips the flow from stabilizing to destabilizing. It's one more reason silver's turning points can be sharp rather than gradual. Put those together and the crash starts to look less mysterious. You had speculative enthusiasm pulling price upward through futures and options. And then you had the system raising the cost of leverage and forcing hedges to reverse. That is how a market can go from euphoria to free fall without a single piece of new information about mines, refineries, or end-user demand. Imagine a crowded theater where everyone is standing on chairs to see better. That's leverage. Suddenly, the people who can't comply have to step down immediately. As they step down, they bump others. Others lose balance. The view collapses. Nothing about the play on stage changed. The structure of how people were positioned did. That is exactly what margin does in a leveraged futures market. It forces people back to the floor. And when the floor is crowded, the fall is not gentle. Now, let's quantify the dislocation in a way that makes it unavoidable. On one hand, you had a paper market that printed a historic upside day, 14% on January 26th, the biggest since 1985 for the active contract. 6 million calls traded, which is not a casual bet. It's a stampede. Then you had a collapse to the high 70s within days. On the other hand, you had roughly $1 billion of ETF inflows in January, signaling broad appetite for exposure. You had London Vault data showing 2,718 tons at the end of December. You had SLV custody above 15,000 tons at the end of January. They scream, silver is being held, even as leveraged players are being forced out. So what doesn't match? If physical appetite is stable or rising, why does paper price behave as if silver is suddenly toxic? Because paper price is not only a reflection of demand, it is also a reflection of forced selling. When forced selling hits, it doesn't wait for a buyer who loves the fundamentals. It hits bids until bids disappear. And liquidity vanishes when risk limits get hit, when margins rise, when volatility triggers model exits, and when counterparties become cautious all at once. That's the dislocation. Paper is pricing a liquidation event, while the physical ecosystem is moving at the pace of custody, logistics, and longer horizon demand. This is the part no one is discussing. When silver fails, it is often failing at a level that matters to positioning, not to geology. Technical levels are not mystical. They are where leverage concentrates. When a level breaks, it doesn't just change sentiment, it triggers forced behavior. So what did silver fail? It failed the narrative of a clean breakout. It failed the expectation that a parabolic move would be permitted to consolidate above the highs. It failed at the moment the system tightened collateral requirements, because the move up was too dependent on cheap leverage. There's also the global angle that's easy to overlook. Silver trades as one idea, but it moves through multiple time zones and multiple microstructures. When Shanghai tightens limits and margins, it impacts participants who are active during Asian hours, which can change how liquidity looks when London opens. When the CME adjusts margins, it changes how US and global funds manage exposure, which then feeds back into overnight pricing. That cross-venue feedback can make a move feel continuous, as if one decision in one market simply echoes through the next opening bell. This is where the East versus West lens becomes useful, not as a slogan, but as a way to track stress. In many commodity markets, physical demand is often more visible in Asian hubs, while price discovery is heavily influenced by Western derivatives. When those two worlds send opposite signals, volatility rises. If physical buyers see lower prices and step in, premiums can firm even while futures fall. If derivatives traders are de-risking, futures can keep sliding even as physical interest improves. Those are the moments when people argue about real price, because the system is temporarily showing two prices at once, the price of paper liquidity and the price of physical readiness. You don't need to guess it, you watch for it. You watch whether reported vault totals drift, whether ETFs keep absorbing, whether delivery behavior tightens, and whether futures open interest contracts as leverage exits. Those are not opinions, they are measurable pressure gauges. And that brings us to what this implies going forward historically. Historically, when silver experiences a margin tightening unwind after a blow-off move, one of two things tends to happen. Either the market continues to bleed as participants de-risk and the trade becomes unpopular, or the market stabilizes and builds a base as physical demand quietly absorbs supply at lower prices, setting the stage for a later, more sustainable move. The path depends on what happens next in the plumbing. If margin remains elevated and volatility stays high, leveraged players remain constrained. That tends to compress upside attempts. If volatility falls and margins normalize, the market can rebuild. If physical premiums rise while futures remain weak, that gap becomes harder to ignore, and it can pull price back toward equilibrium. If industrial buyers step in aggressively and inventories begin to draw down, that provides another anchor. None of this is prophecy. It is the same map silver has followed in other cycles. So let's lay out scenarios, not predictions. A conservative scenario is stabilization. Silver chops, volatility cools, and the market spends time repairing damage. In that environment, the key indicators to watch are whether ETF flows remain positive or flip negative, whether reported vault totals begin to trend down, and whether futures participation falls to a healthier level that suggests leverage has been wrung out. A moderate scenario is a two-stage market. First, an aftershock down or sideways as forced selling finishes, then a rebound as the absence of forced sellers allows price to respond to steady demand. In that environment, you watch for shrinking daily ranges, declining implied volatility, and signs that selling pressure is no longer automatic at each rally. An aggressive scenario is renewed stress through dislocation. Paper prices remain volatile while physical tightness shows up in premiums, delivery times, and custody shifts. In that environment, the market becomes a referendum on settlement expectations. If participants begin to doubt the ease of sourcing physical at scale, futures can reprice quickly. If those doubts fade, the futures market regains control. The reason this all matters is that silver is not just a chart. It is a system. When the system tightens rules, price can move faster than fundamentals. When the system loosens, price can float back toward the underlying flows. And that brings us to the real divide. There are people who experience moves like this as betrayal, as if the market is personal, and there are people who experience moves like this as information, as if the market is a diagnostic machine revealing where leverage was hiding. The difference isn't intelligence, it's what you choose to watch. Most people watch price and then hunt for a story that fits. The few who watch margin, flows, inventories, and positioning can often see stress building before price breaks. Institutions operate in that second world. They moved first because their job is to survive, not to feel good about a narrative. Retail arrives last because the narrative usually arrives last. So when silver fails at a level where it wasn't allowed to, the question isn't who to blame. The question is what the failure reveals. Where leverage was concentrated, how quickly it can be unwound, and how different the paper market can look from the physical ecosystem in the same week. If you take nothing else from this, take this. In silver, the real battleground is not just supply and demand. It is the cost of leverage versus the availability of liquidity. When that cost changes suddenly, the market can move like a trap door, even while long-term holders keep holding. Watch the next reports: margin levels, futures open interest, and any sustained draw in London inventories. When those move together, silver's story changes quickly again. This is signal and structure, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And the question isn't whether volatility returns. The question is whether you'll recognize the signals before the next failure becomes another surprise on the timeline.